Getting straight into some market analysis now, and joining us for that, Rele Adesina, Head of Research at Stanbic IBTC Bank. Thanks so much, Rele, for joining us this morning. Let's get straight into it because, as I said, looking at that markets picture yesterday, it was a bearish tone that the trading week has begun with. What kind of, sentiment has this kicked in for the trading week ahead?
To be honest, Alishia, we've been somewhat concerned about the underpinning for sentiment for the market, in the early part of this year, largely because we expected to see greater commitment by the institutional investors offshore for emerging markets, larger, more established emerging markets, rather than frontier markets like Nigeria. I think if we add to that the fact that we had a bit of uncertainty in January. We've had, a profit warning from UBA, which has kind of led people to have some concerns more broadly about the sector. People are asking questions whether anyone else is going to be affected by Xenon. And so we're having to reassure investors all over again, which I think, given it's the most liquid sector in the market, is weighing on the market somewhat, I would say.
Amidst that very difficult scenario and context that traders are operating in right now, I mean, we've got investors looking to dividend yields, most specifically within the banking sector, and that, it seems, is where interest is moving towards, so that there is that definite earnings, especially if you're looking at things on a time value basis, where you're getting that decent yield without having to wait like you would have to wait for yields on your T-bills.
Absolutely. And this is something we have been highlighting to investors. Overall, our sector preferences lie with the Tier 1 banks, largely because of their robustness within the marketplace and the resilience of their performance over the recent times, including through the challenges that the sector saw. On top of that, there's a healthy upside based on the sort of low levels at which these names are trading. So, you have a First Bank or Zenith Bank at 0.9 times book, GT around 1.6 times 2011 book. So it's still offering value, but on top of that, there is an 8 to 9% dividend yield for these names for 2011, and slightly higher if we look to 2012. And of course, given where we are now in the cycle, taking a position ahead of the record date and getting the dividend in good time, and still perhaps having the opportunity to take some profits and rotate into T-bills would probably be a more robust way of going about exploiting the current position in the market. And even in the Tier 2 names.
Sorry to interrupt, but before you go to the Tier 2 names, Rele, I mean, within that Tier 1 category, distinction has to be made. I mean, you mentioned the likes of UBA, and that's one of the stocks that's really propped up a red flag for investors on the back of the profit warning that it issued recently.
Yes, I mean, we currently have a recommendation of hold on UBA, and our estimates are under review in light of the profit warning. I mean, to be honest, we've had some concerns about how the bank is faring for some time. I mean, it's a good thing to know that finally some write-downs have been taken, and management are at least talking in terms of having cleaned up the book. But we do feel that there is a credibility issue, and management needs to rebuild that credibility, and it will take probably some time. Because under normal circumstances, a bank of that size, a bank with that positioning, to be trading at 0.2 times book should be something that catches investors' eyes. And we think that some people are asking whether now is the time perhaps to relook at the name. But the big overhang is, how can we be sure that, management is going to steer us better this time, when over the last couple of years we've been disappointed by management guidance. So that is a concern.
Let's move over now to the Tier 2 banks, because one of those that stole attention, and I highlighted it a little earlier, was Skye Bank yesterday. It recorded the loan gain in the banking sector, inching up with less than 1%. But this has been, of course, a stock that's been plagued with liquidity challenges.
Yes. I think the other point to make really is that for investors international investors that do venture into the frontier market, they are pretty concerned about liquidity, and they place a premium on liquidity. So a name like Skye Bank, for instance, that has been consistently outperforming in the Tier 2 space from a returns point of view, but may suffer somewhat because it doesn't trade anywhere near $1 million a day, which tends to be the emotional kind of, or the threshold that internationals are comfortable with. So for instance, if they maintain a 50% dividend payout ratio versus last year, the dividend yield on the stock for 2011 looks very attractive at around 15%. But if you can't necessarily get in and then get out when you want to, then it becomes difficult to actually lock down those gains, which I think is something that is something of a concern for some investors. Although we have had also some of our clients taking a fresh look at the name.
Yeah, I just want to touch in on some a story that's filtered through. I mean, on the FT, it reported yesterday that Nigeria will soon privatize 6 state-run power generating companies and 11 distribution companies that are carved out of the Power Holding Company of Nigeria. That would lead to increases in electricity tariffs and hopefully much better efficiencies as well. Rele, have you come across that story, and how's the markets reacted to something like that? Because it will certainly be something that affects companies' operations from an operational perspective, but then also from a cost perspective.
Yes, of course, the power sector and reforms within the power sector and adding capacity and efficiency within the sector is, perhaps the #1 thing that everyone talks about when looking at the potential of the Nigerian economy. We've had estimates of adding 4 percentage points to GDP growth if we can, address power. The process is, clearly it takes a while. I think in the first instance, privatizing those companies is going to mean that local banks will have some impetus in terms of loan growth, because if there are 6 generation companies rather than 11 distribution companies, I would imagine that some of those entities will be sold to investors that will seek financing from local banks. Now that begins to sort of move the needle, we think, in terms of credit extension. And I think that even though T-bill rates are what they are, banks will want to position themselves in those sectors because they are growth sectors over the medium to long term. So that will be the immediate impact. And then of course it takes time to refurbish the physical assets, to upgrade them, for us to begin to see the flow through in terms of generating capacity that begins to then make businesses more viable, that gives opportunity to SMEs to become relevant once again. So I think the first kind of wave of impact will be for the banking sector in terms of loan growth, and then over the sort of 1, 2, 3 year period, we'll start to see more generating and transmission and distribution capacity rather coming on stream that will have an effect on the real economy.
Really, let's leave it there. Of course, certainly that's a story that we're going to have to be keeping an eye on as it unfolds. Rele Adesina is Head of Research at Stanbic IBTC Bank. And of course, she joined us from Nigeria.